Good evening, everyone, and welcome to MYTHEO Live. My name is Roshan Kanasan, Head of Content and Strategic Partnerships here at MYTHEO. MYTHEO is a digital investment manager, more commonly known as a robo-advisor licensed by the Securities Commission of Malaysia. In this evening's MYTHEO Live, we dive into the question, are bear markets great buying opportunities? And we encourage everyone to ask questions about this topic. First things first, though, can I get a little response as to whether everyone can hear me loud and clear? Can we just get a bit of response in the chat, please? Can you hear me loud and clear? All good. All right. Thank you very much, Alia. Now, I think it's pretty clear that this year has been a tough year for markets. In 2022, we've seen a downtrend the entire year pretty much, with the S&P 500 entering a bear market in June and then continue to fall as much as 25% this year. Now, while the markets have staged a few rebounds and rallies, it's still down around 17%, I think just above 17% as of yesterday, leading to a lot of fear and anxiety as to when it comes to investing. However, given that most markets have shown that they will bounce back in time, shouldn't we then consider bear markets as great buying opportunities? We'll get into that in just a little bit, but first and foremost, we've got a few housekeeping notes to go through. Now, among other statements you're seeing on screen right now, please note that this presentation is for informational and educational purposes only and should not be taken as financial advice. The information that will be presented is general in nature and has not been prepared for any particular person in any particular person or classes of person, among all the other things. It is advisable to seek advice from a financial advisor or planner, taking into account your own needs and objectives and financial situations. Also keep in mind, this is really important, that past performance is not indicative of future results. Now, if you have any questions to ask, and we do encourage people to ask questions, please drop them in the Q&A box that has in the Zoom feature. It's somewhere at the bottom of your screen or on the top of your screen. The Q&A will happen in about 20 minutes, I think. I think Matt's presentation will be around 20 minutes. So we'll be getting to that in due course. And now, a little bit about myself. As I said earlier, my name is Roshan Kanasan. I'm the Head of Content and Strategic Partnerships here at MYTHEO. Self-described personal finance nerd. I've done quite a bit in the space. I spent a few years at BFM 89.9 as the producer and presenter of Again Sense. Got my CFP, became a licensed financial planner with Genexo Advisory. I was also doing financial education training. And earlier this year, I joined MYTHEO in the bid to help make personalized wealth management more accessible. Now, a bit about MYTHEO. Now, as I mentioned, again, robo-advisor licensed by the Securities Commission. There are a few things here that, in particular, that make MYTHEO a little bit special. One is the level of personalization that we provide in our portfolios with 228 combinations, which is much higher than most of the competition, old and new. Backed by decades of professional experience. Part of that experience will be joining us in just a little bit. And one thing in particular that we pride ourselves on is the 100% driven by algorithms, right? Where we basically remove the human bias driven by a portfolio, functional portfolio approach. Now, if you have any questions about the MYTHEO product, about the different facets of it, please do ask us in the quick Q&A. Now, with all that said and done, I'd like, today's guest is Matthew Stuart-Box, Chief Investment Officer at MYTHEO. Before joining MYTHEO, or before joining Money Design, he was a Managing Director of BlackRock Japan in Tokyo and San Francisco, and was running the Head of Scientific Active Equity, was responsible for managing around $10 billion in assets. Matt, always a pleasure speaking with you. Is there anything that I missed in your intro with that?
No, that's fine. Good to see you again, Roshan.
All right. With that said, Matt, I want to pass the screen over to you, then we'll get into my questions. But first and foremost, let me stop sharing. There we go. All right, the screen's over to you, Matt. And I've got a list of questions here. Some of them will actually, there's one in particular at the end that was contributed by someone on Instagram, but we'll get into that in a little bit. Okay, great. All right, fantastic. So, Matt, before we get into a question of whether you should be buying in a bear market, whether you should wait for bull markets, first and foremost, can we define what is a bear market for those who may not be familiar?
Yeah, sure. Let's start there. Yes. Okay. So the good thing is, there's a very standard definition of what a bear market is. And this is the one that most people use. This is the definition that S&P use. And they say a bear market is a decline of at least 20%. In their case, they use the S&P 500, but it could be whatever index you're interested in. So a decline of at least 20% from its previous peak. That defines the start of the bear market. And then they say, well, it ends once the index has reached its low and then goes on to reach a new high. So that's the kind of standard definition. I think most people are happy with that. As you said, S&P is in a bear market at the moment. It entered bear market territory mid-June this year, having peaked in January. As you said, there's been a couple of rallies. We're not sure yet whether we really have gone past the bottom yet. We'll find out a bit later, I think. But we're certainly in bear market territory right now for the S&P. But if you look a bit more broadly, there's plenty of bear markets going on outside the US as well. Obviously, Malaysian equities, they've been in a bear market since the end of 2019. Malaysian equities peaked middle of 2014. Took a while to fall to 20% to trigger a bear market. They reached that late in 2019. So they've been in a bear market for 3 years or so. Chinese equities, I was a little surprised to look this up, and they've actually been in a bear market, a technical bear market on this definition, since early 2008, having peaked last quarter of 2007. We'll have a look at the graph perhaps a little bit later, but I'm not sure people realize that Chinese equities have been in a bear market for coming up for 15 years. And obviously you can't mention bear markets without mentioning Japan. Japan's been in a bear market obviously for over 30 years now, having peaked at the end of 1989.
Yeah, man, I just want to re-highlight that point, right? So I think a lot of times people maybe consider the bear market to end when it's recovered, when it hits the bottom, right? But if we're looking at the technical definition, and a lot of us pay attention to the US market because of the size of the market, but things like Malaysia, we've been in the bear market for, technically speaking, if we look at the FBM KLCI, which is the 30 biggest components of the index of the market, it's been about 3-4 years. So it's interesting when you take a bigger look at the overall market, especially when you look at Japanese equities.
Yeah, sure. Yeah. Just looking at some of these markets, kind of on a graph might kind of help a little bit. So obviously this orange one, this is the S&P. So this is the one we're kind of very familiar with. A long rally after the GFC, various ups and downs with COVID and things like that. But here the drawdown started this year, and perhaps a bottom we've seen, perhaps, but we don't know. The purple line here, this is the Shanghai Composite Index. And so here, this is the peak way back here in 2007, October 2007. A very sharp fall since then. That triggered the bear market early 2008. And we haven't reached the peak back from that since then. And then the blue line down the bottom, this is the KL Composite Index. As we said, it's the size of the decline is much smaller, I think, perhaps than what we've seen obviously in China, but peaked back in 2014 and reached bear territory 2019. I think what we can take away from these kind of graphs is, there's a lot of different kinds of bear markets. The Chinese market fell very sharply, went into bear territory very quickly, and has rallied up and down since then, but has never clearly escaped from that bear market. Whereas in Malaysia, it's been a much more kind of sedate drawdown and potential recovery. But as you can see, it's not limited just to the US. There are various markets having bear markets starting at different points and lasting for different periods of time. Normally, if you think about kind of frequency and duration, the best case to use is the US because we've got the longest history there. This is a table I've used in some other presentations as well on these kind of webinars. It's a very good summary of all the bear markets since World War II in the US. And so you can see there's been a fair number of them. I think it's 17 or 18 of them. They're a little bit generous with the definition. They include some that have just done 19, but well, let's leave it at that. But you can see in the US, there's a bear market, every 4 or 5 years on average. The average decline, the peak to trough decline, is around 30%. That feels about right. And then they usually last about 11 months. This definition is looking from the peak down to the trough, so kind of the downward leg of it. And then the recovery normally lasts, just about 2 years, is kind of the average. But you'll notice, there's a big variation. They're not all the same in terms of both the depth of the drawdown and the time it takes for them to recover. But I think one thing we can take away from this is, bear markets are a natural part of investing, a natural part of financial markets. And certainly the one we've seen so far this year is very much in line with, historical US bear markets. It's not exceptional in any particular way. But this point about natural part of financial markets is, I think, an important one. This is the US, obviously, and you could argue perhaps the US is a special case, but you can look at the same kind of thing. This is MSCI All Country World Index. So this is a very broad index, including developed markets, developing markets. And this shows another kind of long run history going back to the late 1980s. And you can see a couple of things, there are material drawdowns along the way. Some of the biggest ones are kind of the well-known kind of end of the IT bubble in the early 2000s, the GFC here, 2008, 2009. COVID doesn't show up actually on this as particularly bad at all, but there you can see it up there. And this current drawdown that we're in at the moment is this kind of peak at the top here. But I think what you can see from this is, there are always ups and downs in the market. And while they are traumatic at the time, when you step back a little bit and look at a slightly longer lens, then they're much less traumatic. And what is much more striking is this steady upward trend, roughly 7 to 8% annual return. That's what strikes you. And so these bear markets that we see every now and then are certainly not unnatural or disasters in any way. They're simply part of investing, I think.
Yeah, so I think that comes now that we've kind of set the base there, Matt, I think we should get to the main question of today's webinar. When we look at bear markets, are they buying, or when are they buying opportunities, right? Because there's a few ways to look at this.
Yeah. Okay. So let's think of when would a bear market be a buying opportunity? Well, if you believe that the market always comes back, then you could argue that every market fall is a buying opportunity. If you're sure that the market is always going to come back, then a fall in the market is just an opportunity to buy at a lower price. And a very good way of seeing it is looking at a long run view of US stocks. This is one of my favorite ways of looking at the S&P. This is splitting the S&P since the war into bull and bear markets. And so obviously the green parts are the bull markets, the red parts are the bear markets. And there's a couple of things that strike you very clearly here. The bear markets are much longer. The bull markets are much longer than the bear markets. When you put it like in this kind of perspective, the bear markets are very short periods of time, not particularly material. And then the upside of the bull markets dominates the drawdowns of the bear markets. And so from that perspective, a very long-term perspective of say, the US S&P, then you could certainly argue that any drawdown is a good buying opportunity. But there's always a but in these kind of things. And the point is, it's not as easy as that. It's very easy when you look at a long-term graph to realize, yeah, you just got to go and buy when the market falls. But it is not as easy as that. When you say it's a buying opportunity, well, what cash are you going to use to buy? If you want to buy the market, you're going to have to use some cash. Most people don't just have spare cash sitting around waiting to be invested. I mean, that would be nice, but most people don't. And so buying a bear market probably means, in most cases, selling some other assets to generate the cash to do that. And so when the equity market is falling, are you really going to sell some other assets that you hold, perhaps bonds or commodities or something like that? Sell those and put that money into equities. Psychologically, that's a very, very difficult thing to do. You see the market falling, you see a lot of negative news. To deliberately sell something that perhaps hasn't fallen or is doing well and put that money into a market that's falling, that's a very difficult thing to do psychologically. And also, timing the bottom of the market is almost impossible. We've seen rallies this year at various points, and so far they've kind of faded away most of the time. It's very difficult to say whether we've actually reached the bottom of this current bear market. So even though, yes, they are buying opportunities, it's not as simple as that. One approach that I think is very effective is this one of investing a regular amount every month, taking a certain amount out of your salary, fixing that amount and just investing it every month, regardless of what's going on in the market. That's a great way to buy in bear markets. You're using cash that you've earned this month, but you're deliberately putting it away every month, regardless of whether the market is down. That's a very good way, I think, of doing it. And you can see that it works. I mean, this is a very simple kind of simulation of what you'd get if you invested $100 every month in the S&P. So this is all in US dollars, so there's no kind of FX or anything like that. It's very, very simple. But if you took $100 every month and invested into the S&P, this goes back to 2001, you'd see that would grow to, on this basis, even after the drawdown this year, over 80,000 US dollars. That's the blue line on there. Whereas, the cumulative amount of money that you've invested, kind of your capital, as it were, that's those gray bars going along the bottom. Well, $100 a month for 20 years or so, that's $24,000. So you can see, even despite the bear market that we've had this year, investing regularly every month would give you what 80,000 is more than 3 times the size of the amount that you've invested. And so you can see this idea of regular monthly investing throughout the kind of stock market cycle can be an excellent way of building a lot of capital.
Yeah, and I particularly like this graph. It's also on our blog if anyone wants to take a look at that article. But when you take a look at the earlier part of this graph, right, Matt, you can see that during the GFC, the crash did go into the capital, right? So for a little amount of time, your market value of your assets, of the S&P assets that you have, were below the amount you had deposited. But if it continued to go on, right, if you take a look at the longest period, every other bear market they're on doesn't come anywhere near to the capital that you've invested. And this is the power of compounding, the power of investing over long term, all these different things that we've covered in past webinars. If you guys want to look at things like compounding, we have a previous webinar on the iPhone, the real cost of buying an iPhone, which you can check out at a different time. But yeah, so this is a great graph. It gives us a lot of context. But speaking of context, right, Now, there are some important nuances that I think we should highlight when it comes to bear markets and as buying opportunities, right? Because sometimes, we always say markets, right, Matt? And what we mean is a diversified pool of assets. We mean the S&P 500. We mean stocks, global stocks in general. We're not talking about single assets. And I've heard and I've seen people confuse this using bear markets as a buying opportunity as, oh, I'm going to buy more of XYZ stock. Oh, the dip is, just Robinhood is down 80%. I'm going to go in there again. So I would like to spend some time on talking about when bear markets or when dips are not buying opportunities.
Yeah, no, that's a very good point, Rashad. I've seen the same kind of comments, and you're exactly right. This kind of argument makes sense when you're talking about a well-diversified portfolio. So let's talk about, when a bear market's not buying opportunities, and we'll talk a little bit about what it means in general, and then we'll look at some real-life examples when it would have been a terrible decision to buy in a bear market. And so the question really is, what if this market that you're thinking of investing in never comes back? Well, what kind of cases could that be? Well, there could be some market-related reasons. It could have been some kind of bubble that has burst, and perhaps it means it's never going to come back. And you could argue that that's the case in Japan. We had a huge economic bubble in the 80s that burst, and the Japanese economy has never really recovered from that. There could be some kind of structural reasons, for the decline, some structural reason why a particular economy is going to stop growing, or a particular company is going to struggle. People also tend to forget, liquidity has an element to do with it. If people stop trading an asset, if it becomes illiquid, then there's a chance that the price will never recover. If people just simply don't want to trade that asset anymore, then you could be stuck holding that asset. And of course, it is possible for some assets to go to zero, to go bankrupt. And we'll look at a couple of cases a bit later on. But the point is here, as you said, these kind of things are extremely unlikely for a diversified portfolio. So a portfolio that's just investing into single stocks, or a portfolio that's just investing into a single market could suffer from these kind of things. But a portfolio that's investing into global equities or a range of assets, not just equities, but fixed income and commodities as well, it's extremely unlikely for it to suffer these kind of things. There's also some personal reasons why, the market could never come back. If your risk tolerance or in particular, your investment horizon is limited, then, perhaps the market doesn't come back fast enough for you. There's always this quote that the market can be irrational for longer than you can be solvent. And that's very true. If you've got an investment horizon where you need a certain amount of money at a certain point in time, there's no guarantee that the market recovers in time for that. So perhaps the recovery is going to take longer than you can afford to wait. So this does depend on you having a long investment horizon. Let's look at a couple of examples of things that never came back. Obviously, one stock that's been in the news a lot has been Amazon. And so obviously it's fallen a lot from its peak, but it also fell an awful lot in the 2000 bear market after the bursting of the IT bubble, and that's this little graph in here. And so this is the year of 2000, and so you can see the S&P fell 9%. Amazon over that year fell 83%. But of course, Amazon recovered. And so somebody who'd kept on buying Amazon, kept on holding, or if possible, even buying more of Amazon at this point, would have seen, well, it would have taken a long time, but they'd seen an amazing recovery in the subsequent decade or so. But another internet stock at the time, pets.com. This was an online shop selling pet food and pet products. This fell 99% in 2000, actually went bankrupt at the end of 2000, and that was it. It never came back. And so anybody who had invested in the equity of pets.com got absolutely zero. And so here's a case where one company did come back, Amazon, but pets.com just went to zero. Another one that's kind of been in the news recently, obviously, is Tesla. You know, Tesla is a great long-term performing stock, but obviously over the last year or so, it's fallen a lot from its peak. And there's lots of comments about, you know, whether this is a buying opportunity or not. I've got no insight particular into Tesla, whether it's a buying opportunity or not. But have a look at this graph. This is also another auto company in kind of the decade leading up to 2009. There's actually General Motors. And people forget, but General Motors went bankrupt end of 2009. It filed for bankruptcy, and anybody who held the stock at that point got absolutely zero. Obviously, afterwards, General Motors was restructured, large injections of cash from the government, and then was refloated. But that doesn't help the people who invested in General Motors before then. They all lost everything. And so here's an example of a absolute blue chip US company. Well, it took a long time, but eventually going to zero. And so these things do happen to single stocks.
Yeah, I know some other examples that come to mind, Matt, that include things like, like Nokia. Nokia was the king of the mobile phone, which was then dethroned by BlackBerry. So, and Research in Motion was the company that was listed, and everyone thought that was undefeatable, it would last forever, and then Apple came with the iPhone and killed that. Kodak, massive company once upon a time. We underestimate a lot of these brands. Like General Motors may sound like, oh, it's just GM, no big deal. But General Motors was a massive company. I think we all forget that, and we forget that the car companies post-World War were massive conglomerates. They were the tech companies of today. That's how people thought of these companies. So, just because, we all think Apple and Microsoft, they've had a really good 2 or 3 decades now with some, waviness, but there's no guarantee that a single stock or single asset like this will continue to go forever. I think that's the main point we're trying to highlight here, and that buying the dip isn't applied equally to everything.
Absolutely, yeah.
So this is one of the common mistakes that we see people make in general when it comes to investing. But when we look at bear market mistakes in particular, Matt, what are some of the common bear market mistakes we see investors make, and how do we avoid them?
Yeah, sure. So most of the mistakes that people make during bear markets are essentially behavioral mistakes, and you can kind of group them into 2 main areas. The first area is panicking, rushing and making a decision to sell based on what's going on in the market. And this is very easy to do. You look at the news every day and you see, the market is down, the market is down, the market is down. And you think you have to do something. And you see your portfolio dipping into negative returns. You think you've got to do something to stop that. And the only thing you can do is sell it. But we've seen time and time again, that's a very bad thing to do. It means you'll miss any recovery. It means you'll pay a large amount in trading costs. Trading while the market is very volatile. You'll lock in all of your losses essentially. So how could you avoid this kind of thing? How could you avoid this panic selling? Simple things. Just forget about the daily financial news. It doesn't, for a long run investor, it really doesn't matter what the market is doing today. I mean, it's interesting entertainment sometimes, but it really doesn't matter. So maybe watch the news every now and then, but don't follow it religiously or anything like that. And don't look at your account every day. I know it's also very tempting, and MyTheo has a great app where you can go in and see, real time your performance, and that's nice. But certainly in a market like this, checking your account every day, checking your performance every day, is not going to help you. Things you can do: make a plan, stick to it. This can be a plan in terms of asset allocation. It can be a plan in terms of regular investing, but make a plan and stick to it. Obviously, you should keep some spare cash for emergencies. Most financial planners would mention that. Keep several months worth of spare cash on hand, so you don't have to sell any assets to cover short-term emergencies. But these are all things that I think you can do to kind of avoid panicking, selling, and rushing your decisions. So that's one group of mistakes, I think. The other group is almost the opposite, going too bullish, trying to time the bottom of the market, trying to pile in at the bottom. Obviously, when you look at these kind of long-term graphs, and you see the kind of return that you could earn by investing at the bottom of the cycle, it's extremely tempting. The point is, it's extremely, extremely hard to know when the market has bottomed. You only know that after the fact, when you look at the graph afterwards. But at the time, it's almost impossible to know that. So first thing you can do there is ignore people who try to predict the bottom. And there will always be people who say, right, now's the time to buy. Now's the time to buy. And you should ignore those people. Just by law of chance, some of those people will be right. It's just random. It's just random. Don't make big sudden changes to your portfolio during a period of volatility. You'll just be paying transaction costs and things like that. And just keep going, keep investing regular amounts every month. That's your most reliable way of benefiting from a bear market. So these kind of mistakes are, I think, the most common ones that people see. These are the kind of ways you can get around them. But the obvious point to make is an automated investment service, a robo-advisor, such as MyTheo or other similar services. They can help you avoid these kind of mistakes. They can take away a lot of this kind of behavioral biases and make sure that your portfolio stays in the right position, in the right setup throughout the market.
So on that note, Matt, speaking of MyTheo in particular, how does MyTheo's investment strategy help investors in, say, a bear market like this? Because we talked about a few of the USPs earlier on. How would that react in a situation like this?
Yeah, sure. So maybe let's just recap just briefly kind of how MyTheo works. So MyTheo has a proprietary set of algorithms, in particular a profiling algorithm that provides you with a recommended portfolio that's tailored to each investor based on their needs for long-term growth, for income, and for inflation protection. This is what the portfolio would look like. You'll see here, depending on the allocation that's best for you, a certain allocation to growth. These would be mostly equities, an allocation to income. So these would mostly be bond ETFs, and an allocation to inflation hedge. So these would mostly be real assets, real estate, commodities, and things like that. This allocation will vary person by person depending on their situation. But you'll see the recommendation that MyTheo gives you. And then you'll see kind of, the performance, back-tested performance that you'd have in the past, some estimates about what performance you could expect in the future. So how does MYTHEO help you? Maybe three areas. One is diversification, one is discipline, and one is simplicity. In terms of diversification, all of the MYTHEO portfolios are extremely well diversified. Everyone gets allocated to three different asset classes, these three functional portfolios. We have over 50 ETFs in our universe. I think that's more, than pretty much any other robo-advisor. And then underlying those ETFs are literally thousands of underlying securities, underlying equities, bonds, commodities, and so on. And so by investing into MYTHEO, you're automatically getting a very well diversified portfolio. Discipline, I talked about having a plan and sticking to it. That's very difficult for a human to do on their own. MYTHEO can help because we, as you mentioned at the start, all of our portfolios are driven off algorithms. They're 100% algorithm driven. This removes human bias. It takes away a lot of the kind of behavioral problems that people have when they're investing. So your portfolio will automatically be rebalanced every month. All of the trading decisions will be determined by those algorithms. You won't have any humans stepping in to make decisions in there. Then finally, simplicity. I think this is valuable, especially when the market is as volatile as it is here. All robo-advisors and MYTHEO as well are relatively low fees compared to a lot of other investment products. They're very easy to use. They're transparent. You can see exactly what you own. They're fully automated. And so having something that's simple, easy to understand, and relatively low fee is also a good thing, I think, in volatile markets.
Right. Now that we've addressed that, Matt, I want to get to one of the questions we got over Instagram, because we were posting this.
Nice.
I mean, we told everyone earlier that we were doing this webinar, and there was one question in particular that was very interesting, and I think we should address it, right? And the question was basically, should investors wait for bear markets to invest and avoid bull markets? We've kind of answered that question earlier, but I'd like to let's condense it into one point here.
Sure. I think that that's a very good question, because you do sometimes see those kind of comments that you should kind of just wait for a bear market and then invest, and not invest during the bull markets. And so this is a very tempting argument, but in my opinion, it's a very dangerous argument, and it's not something that I would recommend. Couple of points to make. You only know that a bear market has started or a bear market has ended after the event. We said that a bear market is defined by 20% fall. At the start, as the market starts to fall at the start of a bear market, you don't know how far it's going to fall. You don't know that this is going to be a bear market until it's fallen the 20%. And similarly, especially, you don't know the end of a bear market until afterwards. There's lots of false dawns, lots of false recoveries. And so this idea of just investing in a bear market, not investing in a bull market, first off, you don't know at the time whether you're in a bear market or whether the bear market has ended. So number one, it's a very difficult thing to know at the time. So unless you can predict, unless you can time the market, you're always going to be reacting after the event, and that's going to put you on the back foot. The other point to make is, we've made this point earlier, and we've seen it in various different forms. Bull markets tend to be much longer than bear markets in terms of length of time and the size of the returns. And so the opportunity cost of sitting out a bull market is extremely high. You can see, this is the same graph that I showed earlier of the MSCI all country world index over the long term, and it's dominated by the upward, the bull market phases here. And so if somebody's really recommending that you should sit out all of these upward parts of the market, I don't think that's really kind of realistic. And so in this kind of idea, environment, holding a diversified portfolio and dollar cost averaging, just keep investing a regular amount every month is, in the long run, I think, a much more realistic approach than trying to time a bear market or a bull market.
All right. Thank you so much, Matt. I think we've covered all the main questions here. So before we get into the Q&A, and some questions have come in, maybe we could just wrap up the session before we get into the Q&A itself.
Okay, sure. Yeah. So, so from the point I wanted to kind of get across with this thing is, first off, bear markets are a natural part of investing. They're nothing to be afraid of, nothing to panic over. They happen every 4 or 5 years, normally take about 2 years to recover, but it can take longer. They can be dangerous if your portfolio is concentrated into single assets, single stocks, single markets, then it can be dangerous. But if you're diversified, there's certainly no need to panic. If you want to survive a bear market, well, you've got to diversify, you've got to stay in the market, you can't sell and get out, you've got to stay disciplined, and you've got to keep investing regularly. And, an automated advisor such as MYTHEO, that's a very good way of helping to do that kind of thing.
Awesome. This is pretty much the compressed version of the entire situation, right? Ladies and gentlemen, bear markets are a natural part of the investing cycle, happen 4 to 5 years. And this, you've got a little toolkit there, how to survive bear markets. I quite like the way you phrased it. We've got some questions coming in, Matt. I think we've got just about 2 questions right now. All right, so this might be quite a relevant question here. MYTHEO's portfolios seem over diversified compared to other products out there. How would you respond to that, Matt? Because I think it's important to address the difference between diversification or intelligent diversification versus quote unquote diversification, right? Because there is a point where, if I buy 5 different S&P 500 funds, I'm not really diversifying any better. How would you respond to this?
Yeah, sure. Yeah. So this is a very good question. And you're quite right. If you look at some of the other robo-advisors in the market, they tend to hold a smaller number of ETFs. Perhaps 8 or 10 ETFs might be more common. There's maybe the way to think about this is diversification is not the purpose of investing. So how do you know whether you've got the right amount of diversification? Well, the way to think about it is not to try and focus on getting as diverse a portfolio as possible. That's not the point of investing. The point of investing is meeting your objectives, be they return objectives or risk objectives, whatever. And so you have to start from that point. And that's what MYTHEO does. It tries to work out what are the requirements from an investing point of view in terms of risk and return of this investor. Start from there and then find the portfolio that's going to meet your objectives with the least amount of risk. After all, why take more risk than you have to in order to meet your objectives? Okay, so you build a portfolio that you think is going to meet your objectives, meet your return objectives with the least amount of risk. That's the right amount of diversification you should have. And so MYTHEO does tend to hold a larger number of ETFs than some other competitors. It's simply trying to achieve your objectives without taking any excessive risk. Obviously, after the fact, you can look at your portfolio and see, if I hadn't held this stock or if I hadn't held this ETF, my performance would have been better. But that's after the fact. But holding a portfolio of maybe 8 or 10 ETFs, in my opinion, means that you're not properly diversified. You're not properly diversified. You're taking more risk than you need to take in order to meet those objectives.
Yeah, and I think it's important to note that each ETF in the portfolios or in the different 3 portfolios has a function in there, right? So it's not all, we're not buying thematic ETFs, for example. We've got geographical allocations, and then in the inflation hedge portfolio, there are tips and gold in allocations that, based on the data, on fundamental evaluations, make sense over the longer term. Some other questions have come in, Matt, and this is a really good one here. Is there any reason to have a diversified portfolio like MYTHEO's, given that all the examples here have been using the S&P 500? I mean, we use ACWI at one point as well. Shouldn't we just buy the S&P 500 ETF directly? Yeah, Matt, over to you. I have one particular thing I'd like to say at the end, but over to you first.
Yes. That's a good point. Yeah, yes. And maybe it's dangerous to focus too much on S&P 500. I mean, you got to be honest. The S&P 500, the US stock market is what, 60% of the global equity market, and so it's not something you can ignore. And so it's I apologize if I've used S&P data. It's easy because there's a long history and stuff like that. Well, should I just go and buy an S&P 500 ETF? That's one approach. What you'll end up doing there is taking a lot of risk on a single country and an awful lot of risk on a single currency. We've seen, that individual countries can enter a bear market and stay there for a long period of time, And, the US historically has been very resilient in terms of bear markets. But there have been cases where the US has stayed in a bear market for, 10 plus years, if you look back far enough. So you could go and just simply buy S&P 500 ETF. You'd be taking a large amount of risk on the US economy. And it might work, it might not. I think for most investors, you'd be better off at least investing globally in equities. And for almost all investors, they would also benefit from holding non-equity assets as well, at least some fixed income and at least some real assets as well.
Yeah, and I think there's something to be said about, we can look back at like the Nikkei 225, for example. Geographically, countries can go into a bear market for a very long time, or, Japan's stock market was one of the larger ones before the US became so prominent after the 90s, if I'm not mistaken. So these kind of geographical shifts can happen in your lifetime. No one's saying that the US is going to fall apart in the next decade or the next 2 decades, but are you really going to bank your entire asset base on the US for the next 50 years? If you're young, next 20 years, if you're older. These are the kind of permutations you're going to consider. Like, again, as Matt said, you could totally go and just buy the S&P 500 by yourself and do that if that's what you want to do. But there are other asset classes that aren't equities that you may want in your portfolio. Your gold, tips, property, all have different functions in a portfolio. There are many different ways to build wealth over the longer term. Find one that works for you. And at MYTHEO, we believe that this works for many people who don't want to be worrying too much about the details. Okay. Another question on geography this time. I mean, still on markets here. I'm not sure how much we can address this, Matt, but maybe let's try. Is China worth investing in, given the meltdown happening there Is there any signs of recovery soon? I mean, this is a variation of a similar question we've heard a few times in a bunch of the webinars. It's China is looked to by many fund managers and many investors as a place for long-term growth, but there are some stop-starts here. Any thoughts on this?
Yeah, sure. So there's a couple of things we can say about this. Right. There's certainly a case right now that, globally speaking, Chinese equities are relatively cheap. Even after the falls in the US, Chinese equities are cheap globally. And so there's an argument, even just from like a relative value point of view, that Chinese equities might be a good thing to own right now. We've seen in the graph earlier on that the volatility of Chinese equities is high, materially higher than certainly the US, but also materially higher than many other emerging markets as well. And so investing in Chinese equities, even though they're relatively cheap right now, means taking on a large amount of volatility. And you have to understand that going in. We've seen, extremely large movements even this year in Chinese equities, both down and then up. So you could have a very rough ride in there. Maybe perhaps shifting and thinking perhaps from a longer horizon point of view. Even though GDP growth in China is slowing at the moment, it's still materially higher than most developed countries. And even though it's struggled through the last couple of years of COVID, I think there's still a structural case for higher GDP growth in China relative to a lot of other countries globally. However, when you invest in the stock market, you are not investing in GDP. The GDP can grow and the stock market can fall. There's no reason why the stock market has to be tightly correlated with real economic growth. Obviously, in the long run, economic growth does help companies to grow, but there's certainly in the kind of the short to medium term, there's no correlation between stock market returns and GDP growth. So I think the argument for investing in Chinese equities based on economic growth is a very dangerous one to make. You're buying an asset that is cheap at the moment, but highly volatile, and there's no reason why stock market should recover simply because GDP is doing well. Having said that, China is a material part of the global economy. The Chinese stock market is a material part of global equities. You should have China somewhere in your portfolio. MYTHEO certainly has China, both mainland China and Hong Kong, as part of its investment universe. But putting a large amount of your assets into China is a risky investment idea, I think.
We've got one question left, I think, before we need to wrap up, Matt. Before that, could you move over to the next slide, please? One more. Okay, great. So last question for today. Is Malaysia headed for a recession in 2023? If yes, how do we best prepare in terms of our portfolios? How does MYTHEO plan to address it? So I think there may be a few ways we can address this, Matt.
Yeah, sure. So I'm not an expert on the Malaysian economy. My understanding is that there are very few people forecasting a major recession for Malaysia. If you think of kind of the normal technical definition of a recession, 2 months of negative GDP growth, that's perhaps possible, but I don't think any serious economists are forecasting a severe recession for Malaysia. But I think it's important to think when you're investing, to think about investing globally. Investing simply because you're in Malaysia, just investing in Malaysian assets is, I think, a very risky thing to do. You're putting a lot of your capital in essentially a single country. And so the way MYTHEO deals with this is to be completely globally focused. Certainly we have Malaysian assets in our portfolio, but we have no particular tilt to any country or any region within the portfolio. It's a purely global portfolio. And that's probably the best way to deal with a recession in any particular country, be it Malaysia or any other country, is to make sure that your portfolio is not overly invested in any particular country or any particular region.
All right. On that note, ladies and gentlemen, we have, I think, just perfect timing. It's about 2 minutes before, but I think we can wrap it up here. Ladies and gentlemen, with that, we've come to the end of our session today. Thank you so much for your time and your questions. We always appreciate them. And in fact, we learn from them as well in terms of what you guys want and what you guys are looking at. A huge thank you to Matthew Stuart-Box, the Chief Investment Officer of MYTHEO, for taking the time to be with us today. And if you'd like to keep up to date with MYTHEO content or enjoy the next webinars, please follow us on Instagram to keep up to date. This is the last webinar for the year. So wishing everyone happy holidays, Merry Christmas, Happy New Year, and we'll see you all in 2023. Yes, goodbye, and see all of you in the next one.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. MYTHEO is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, MYTHEO will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way MYTHEO optimizes your portfolio. The algorithm that drives MYTHEO's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision making. With MYTHEO, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What MYTHEO does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, MYTHEO's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.